guys? Michael Edward, head trader at True Trading Group. March 4th. This crazy market continues. Another day, another 1,000-point move in the Dow. We were up over 1,100 points today. We closed at the dead highs of the day. Monster move. All right, we go take you guys to the daily chart. Here you guys can see the size of these candles. It seems like almost every day now we're getting 1,000-point move in the Dow when it was unheard of prior to 2 weeks ago. Now it's almost a daily occurrence. It's crazy. This is a really good video. I want you guys to pay close attention, especially those people that are maybe new to trading, that don't necessarily have a financial background, because with this video, I'm going to give you pretty much an economics lesson, more so than I'm going to give you a technical trading lesson. But this economic lesson will help you greatly in moments of intense volatility in the marketplace, because there is specific correlation that takes place between equity markets and bond markets during moments of intense volatility and uncertainty and fear, like we have seen over the last 2 weeks, that you need to understand to be able to pick direction. Okay, that is what I'm going to really talk to you about, is during moments of intense volatility, how can you use the bond market to give you a signal so that you're on the right side of a trade? Do you think the market's going up? Do you think the market's going down? Or is the market just going to base out and pretty much trade sideways? This is something that occurs during these moments of intense volatility, and I'm going to explain to you how the bond market works, why it's important, why in True Trading Group chat I have been paying very close attention to the 10-year Treasury note, the 10-year Treasury bond yield, and why I am paying attention to it, and how that was able to help us pick direction in the afternoon in the SPY. Now, I did not trade the afternoon in the SPY. The purpose of this video is not for me to say, look at this amazing trade that I made. I sat back today because we got a very, very choppy action in the morning. The gap up today really kind of threw me for a little bit of a loop. We had Joe Biden with the strong Super Tuesday showing. That eased a lot of fears from a possible Bernie Sanders nominee, which the socialist policies would wreck the U.S. economy. The stock market would sell off. And you saw that today in healthcare. Healthcare stocks were up big today. United Health, UNH, huge gap up today. That is just because of Joe Biden's victory on Super Tuesday. Okay, there's the big gap up on United Health. So you saw a lot of the healthcare names gapping up because of that. Okay, so I'm going to talk to you guys. Actually, the SPY real quick. The gap up today on the SPY had me like, you know what? I'm not confident on direction. Okay, I'm not confident we're going to push higher. I'm not confident we're going to pull back in. We were gapping up today, but right dead smack in the middle of yesterday's high and yesterday's low, and right there was where we opened. So that was a little bit of a move. If we gapped down today, if we opened up somewhere in here, direction would have been clear. I would have looked for the market to pull in today, but the gap up had me hesitant. All right, has me hesitant, and the market did nothing in the morning session. We just bounced around and traded sideways. But the afternoon, we rallied hard. And that is where the bond market comes into play. And that is why I'm going to talk to you about the bond market and why it's relevant, especially during times of intense volatility. So guys, listen up. You're really going to learn something about economics and how this all relates. Okay? Now, the bond market. First, let's talk about what is it? Treasury bonds. You're basically buying debt from the U.S. government. Okay? It is considered one of the safest, if not the safest, investment that institutional investors will make, because no one ever fears that the United States is not going to be able to pay its debts. So bond investments are very, very risk adverse. They're not risky at all. You know exactly the return that you will make on your money because the yield is the yield, but it is a sure thing. Right now, you have a lot of uncertainty in the equity markets. The equity markets, which is a regular stock market, there's a lot of uncertainty. There is no sure thing. No one knows really what the economic impact of the coronavirus is going to be yet. It's unknown. Okay, so Wall Street doesn't like the unknown. So what you've seen happen over the last 2 weeks is money has flowed out of equity markets. Okay, the stock market has crashed, and it has rushed into the bond market. And institutional investors are taking their money out of the equity markets because it's too high risk. Equities are seen as too high risk at this point in time. Obviously, with the volatility that we are seeing, what more proof do you need of high risk than a Dow that's up 1,000 points one day, down 1,000 points the next? Intense volatility, intense uncertainty, much higher than normal risk in equity markets. So investors are pulling money out of the equity markets and they're pushing it into the bond markets. As investors buy bonds, the yield on those bonds goes down. It's simple supply and demand. Okay? The more people that buy, the more demand there is for those bonds, the less yield those bonds need to give investors to attract investment. Okay? When there's a lot of demand for bonds, the yield can be low. When there's little demand for bonds, the yields need to be high to attract investors to buy those government bonds. All right? So just over the last couple of days, bond yields have seen all-time record lows. All-time record lows. And that makes perfect sense. You have institutional investors from not just the United States, but all over the world that are flowing into U.S. Treasury bonds because you have all this uncertainty around the globe about the global markets, global GDP, and the countries that are hit the worst right now are China, South Korea, Italy, and Iran. Now, during moments of uncertainty like this, if there has ever been a certainty out of all the equity markets in the world, out of all the bond markets in the world, the thing that is the most certain is the U.S. bond market. You are seeing investors from all over the world, from Italy, from China, from South Korea, taking money out, also in other countries, France, etc., taking money out of their equity markets and dumping it into the U.S. bond market. That is including U.S. investors. That is why U.S. bonds have gone to record low yield. When bonds go down to record low yields, or when the bond market is dropping in general, that a lot of algorithms, trigger. Bond rates are a key component to a lot of algorithmic equations. As bond yields fall, that's a signal that risk appetite of investors is decreasing. Because as the bond yield goes down, that means money is flowing into bonds. Money flows into bonds as a flight of safety. That's because investors don't want risk from equities, they want safety from bonds. So as the bond yield goes down, that means investors have a lower risk appetite. That will trigger selling in algorithms to lighten up high risk investments, which would be the equity markets. All right. And for those algorithms that maybe they're not triggered to sell as the yields come down, at least they're not triggered to buy and buy aggressively as bond yields are going down, because it's signaling a decrease in risk appetite for investors. Okay. That is what has happened in the bond market. Now, coming into the day here today, yesterday, let's talk about yesterday first. Yesterday, the Fed cut interest rates by 50 basis points. You had this quick spike, and then we completely sold off like crazy. The reason why we sold off like crazy is because during this time, the 10-year Treasury yield dropped below 1%. First time in history, the 10-year yield was below 1%. That has never happened before. Prior to 2 weeks ago, the all-time low on the 10-year Treasury yield was 1.3%. Yesterday, we went down to 0.95, all-time record low, hence the market sell-off. Investors pulled money out of equities and dumped it into bonds because of all this risk and all this uncertainty, and the Fed moving with their surprise rate cut. It's not even necessarily the 50-point cut. It's the surprise rate cut spooked people. They saw the equity markets as even more risk. Money flowed into the bond market. Okay? Then overnight, you get very few increase in cases in the US. You had a few more in California, a couple more in New York, but it wasn't like a widespread pop. You had Joe Biden, strong performance in Super Tuesday. So he removes the socialist policy risk of a socialist as the Democrat primary. Markets gapped up. However, the 10-year yield was still below 1%. So you had these other catalysts that caused the equity markets to gap up. But the bond yields still remain low. For that reason, today in the morning, I said to everybody in chat today, I go, guys, if you are thinking about buying this gap up, be careful, because I said as long as the 10-year yield is below 1%, I think the market will have a hard time getting legs. As long as that yield is below 1%, which is unheard of, I think the market, maybe the market goes sideways, maybe it goes up a little bit, but to really have legs, I said I didn't think that's possible with the 10-year below 1%. So we sat on our hands. Today was a day of patience, a day to sit on your hands, okay? And it wasn't until around 12:30, and you guys can go and you can check the charts of the bond yields. You go look at the 2-year, look at the 10-year, okay? I focus on the 10-year. All right, mortgage rates are most closely tied to the 10-year, not necessarily some of the larger ones. The 10-year really is the main yield that you want to pay attention to. The 10-year yield started moving higher at around 12:30. Okay? The bond yield started to bottom out. We were at 0.96, 0.965, 0.97, 0.98, 0.99, 1%, 1.01, 1.02, 1.03. And the market started rallying going into the close. You had like a 600-point rally, okay, in the afternoon as the 10-year yield went from sub 1% up to 1.038, I believe is where we ended up the day. 1.038, I believe, is where we finished up the day, somewhere around there. And that is because once investors and algorithms start to see the bond yields rising, that signals institutional investors going risk on. They're starting to add risk. They're starting to sell safety. They're starting to sell bonds. And if they're selling bonds, then that means their money is starting to move back into equities. That's when you got direction in the market. You did not have direction today while the 10-year yield was below 1%. As soon as the 10-year got above 1%, that's when you got direction in the market. Now, during moments of intense volatility like this is when this correlation becomes very evident. This is not something that, if the bond yield goes up, that means we're going to go long the market, and it's just that easy. It's not just that easy, but there's a correlation. And understanding this correlation, and this plays right into, I just released a new course for our members. I told you guys about it in my last 2 videos about how to survive and thrive during a stock market crash. This is the kind of stuff that you need to know that nobody talks about because they're too busy selling you on some gimmicky trade idea, okay, that don't give you a true education and understanding of how the equity markets work. And when you get intense volatility like we're having, it's important to keep an eye on the bond market because it can help you be on the right side of a trade. It may not give you the exact entry point that you need, but it can help you with your bias. It can help you to say, I want to be long, I want to be short. It can help you say, I don't really know if I want to do anything, I'm going to sit on my hands. Because during moments of intense volatility like this, intense fear, intense uncertainty, when bond yields go down, the market will have a very hard time really pushing higher. So if you're maybe in a SPY call option and you see tomorrow, okay, you're in SPY calls, and tomorrow the 10-year yield goes from 1.035 to 1.025 to 1.02 to 1.01 to 1.0, you better second think, or you better really think hard about holding on to those SPY call options, because the market's going to have a real hard time pushing higher if the bond market is signaling investors are going risk off and they're going to safety. Okay? It's not a coincidence that the stock market rallied today at the same time the bond market started to move higher. That is the correlation I want you to pay attention to. That is the correlation that will help you during times of intense volatility. Now, let's talk about the SPY. What I think is going to happen. This bounce back on the SPY, I think we have a ceiling. I think we have a nice little ceiling here around 313 to 314. Okay, I like this area here. We're trading lower after the bell. You got a little bit of a double top here. You had some prior support back here. We broke below. It became resistance. We have a little bit of a ceiling here around 313 on the SPY. As I go all the way back, let's go out to an hourly chart. As I go all the way back, you can see this level become significant again. There's support. There's resistance. There's resistance. This level has become a thing of significance. Okay? What I think we're going to see happen here in the SPY over the next, couple days is I think we're going to round out. Okay? I think we're going to get a rounded top. I think we might consolidate in this range for a couple days, but eventually I think we pull back down, and I think we go back down and test this low. So I think we consolidate in this region for a couple days, can't get through 313, 314, and eventually we pull back down below 300. If we do not get above 314 tomorrow, I will start to look at SPY call options as a swing trade, maybe getting long the TVIX as a swing trade for the SPY to get back below 300. Today, I started looking at the 305 strike March 9th expiration put options, something that I'm keeping an eye on. Had really good volume in those options today. I like that price point. I like the volume. I like the interest in it, being that it's a couple expirations out, because you had today's expiration, you got Friday's expiration, then you have Monday's expiration. I'm looking at Monday's expiration. Maybe the weekend also gives us time to get an increase in cases in the US. A news headline scares the markets. We pull back in. I'm thinking about a rounded top up here in the SPY and eventually a pullback. We'll see what happens tomorrow. Keep eyes on that 10-year yield. If the 10-year yield gets up to 105, 106, the markets will push higher. But if all of a sudden tomorrow the SPY cannot get through 314, 313, 314, just can't get through it, and all of a sudden you see those bond yields on the 10-year start to drift back towards 1%, they get back below 1%, I think it's time to strike for some SPY put options or to get long the TVIX, because I think the market will round off and then pull back below 300. We'll see if I'm right. I'll see you guys in chat tomorrow. I hope this video helps. A nice little economic lesson. Okay, a nice economic lesson about the bond market and how it relates to the equity market and how those two are tied together. So I hope this helps you guys being able to trade better and safer and smarter in this moment of intense volatility. I'll see you guys in chat.